The stock market is jumping from one record high to the next, and as we all know, that's mainly due to 7 companies that are leading the way in artificial intelligence. Profits are soaring and share prices are rising even more sharply. The higher these stocks climb, the more nervous many investors become. And today I want to show you why I don't get nervous, how I invested more than 10,000 euros last month, and how my passive income is currently developing. With that, welcome to Northern Finance. My name is Alex Black.
Hi, my name is Alex from Northern Finance. This video was translated with the help of AI so that we can reach more people in their own language. A native speaker has reviewed the translation. Still, some sentences might sound a little unusual. Thanks for being here and enjoy the video now.
Yes, today in this portfolio update, we'll start with the Magnificent Seven: Amazon, Alphabet, Apple, Microsoft, Nvidia, Tesla, and Meta. Together, they now make up 37% of the entire S&P 500. That's truly incredible, especially when we look at the share of the Magnificent Seven in the S&P 500 since 2013. The S&P has never been this dependent on tech stocks before, and of course that also has the potential to drag everything down. If the hopes for stronger profit growth through more artificial intelligence, which the market clearly has right now, do not materialize. It's also important to mention that the Magnificent Seven do not manufacture their own chips. Not even Nvidia, even though the media often makes it seem that way because of the presentations of their latest chips. But in reality, Nvidia does not manufacture any chips itself, rather it is the architect behind them. They pass the blueprint on to TSMC, the world's largest chip manufacturer from Taiwan. And only TSMC is currently able to produce the highly sought after AI chips. No other company in the world can match this quality when it comes to building such small and powerful GPUs. TSMC in turn is highly dependent on ASML, the largest manufacturer of machines for producing AI chips. And ASML in turn is extremely dependent on Carl Zeiss, because they are the only manufacturer of ultra-precise mirrors which the machines for AI chip production need in order to ultimately build these chips. And if at some point there are problems at these companies and they can no longer deliver as promised, maybe due to a supply chain error, or if China were to attack Taiwan, which isn't unrealistic, then this would trigger a major crash on the stock markets, because the Magnificent Seven are extremely dependent on ever more and ever more powerful AI chips. Because all of these companies use Nvidia chips, which are made by TSMC without exception. Or actually, there is one exception, Apple. For example, they make their own A19 chips in the new iPhone, or the M5 chip in the latest MacBooks. But even here, Apple only provides the blueprint. The actual implementation is only done by TSMC in Taiwan, and that's dangerous, no question about it. Many companies are aware of this too, and I think in the long term, this dependency will decrease. But now I also want to address the arguments that we're not actually in this big bubble and that there are indeed good valuations that still justify getting in here. The fact is, about a third of the companies in the S&P 500 have already published their quarterly results, and of those, 86% have exceeded profit expectations. By comparison, the median over the last 20 years is 73%. And Meta, Microsoft, and Alphabet also released their figures yesterday, and all of them beat their profit expectations. However, for Meta and Microsoft, the spending on artificial intelligence was apparently too high, and each stock lost a few percentage points. In general, among all the companies in the S&P 500 that have published their figures so far, revenue forecasts were also beaten, in fact in 83% of cases. So right now companies are generating more revenue and profit than ever before. At least based on what we know so far, and that's simply much better than expected, and that combined with strong economic growth in the US. Last year, and even though the first quarter of 2025 was weaker, the second quarter was all the stronger. And this growth in the US is expected to continue. And the head of the American Central Bank, the Fed, had the following to say about this week.
This is different in the sense that these companies, the companies that are so highly valued, actually have earnings. If you go back to the 90s and the dot-com, these were ideas rather than companies. So there's a clear bubble there. I won't go into particular names, but they actually have earnings. It looks like they have business models and profits and that kind of thing. So it's really a different thing.
Whether that will come true remains to be seen, but even the economic growth forecast for the US by Goldman Sachs is at an average of 2.1% per year over the next few years, supported by artificial intelligence. At the same time, workplace productivity has actually increased more in the last 5 years than before the pandemic, and starting in 2029, economic growth in the US is expected to accelerate even further, as shown in this chart, along with productivity growth. So yes, there is a concentration at the top of the stock market, and there are risks, but at the same time, not only the companies at the top, but also the rest of the companies are currently exceeding revenue and profit expectations. And in the long term, I'm simply an optimist because it's worth it. As we all know, you always get a good return on the stock market in the long run if you invest over 10, 15, or 20 years, and that's exactly what I plan to do. And before we get to the new purchases specifically and my passive income from last month, I want to show you my portfolio's performance on the chart here. Here we have the returns of my most important investments this year, and as you can clearly see, at the end of the month when I'm recording this video, my emerging markets ETF has by far the best performance this year and by a huge margin. We're currently at 18% this year, far ahead of the MSCI World. I've always had a high proportion of emerging markets in my global portfolio strategy. I've been laughed at for that for a long time. I started back when I lived in China for half a year in 2018 and realized just how incredibly the country had already developed and what was still to come. And that's why I simply wanted to invest more in the emerging markets. In recent years, that hasn't paid off yet. You have to be honest about that. But right now, things seem to be turning around, and given the high risks, especially when it comes to artificial intelligence, the concentration of just a few companies in America, and the very high price-to-earnings ratio of now 25 in the MSCI World, I'm actually quite glad not to be putting all my eggs in one basket here. A price-to-earnings ratio of 25 in the MSCI World means that at current profit distributions, it would take 25 years to get your investment back, and that's simply very expensive when it comes to stocks. As you can see here in the chart of the MSCI World price-to-earnings ratio over the years, we're now at 25, and this value is higher than it has ever been in the last 30 years. You have to imagine that, except for a few weeks right before the bursting of the dot-com bubble in 2000. After that, year after year, the ratio kept dropping, first to 19, then to 15, and finally during the financial crisis in 2009, it even fell below 10. But things look different with the MSCI emerging markets. Here we have a price-earnings ratio of currently 14.5, which is also historically high, but I believe that in the long term, there is potential here for emerging markets to establish themselves and become the new developed world, or at least to approach those valuations over the next few years. The more years go by, the more likely this will happen. That's my forecast, but as always, this is not investment advice. That's why I've always invested here with my 50-50 split between the MSCI World and emerging markets, and while I hope that profits will continue to grow in the S&P 500 and the MSCI World so that we are no longer at these historic peak valuations, as you can see here, I'm still happy if it performs well, of course. As you can see here in the chart, represented by the green line, P2P loans are my second best investment this year with a current return of 9.3%. And the overall portfolio is at 5.7% because Bitcoin has been underperforming lately. That brings us to my new investments. This month, I bought my ETFs again, specifically 15 shares of the MSCI World at €109.50 each, and secondly, the MSCI Emerging Markets with 39 shares at €38.40 each. Altogether, that was a little over €3,140. I also reinvested €140 in dividends here. And for that I only paid €5.08 with my broker Freedom24. And with that I can trade on all major stock exchanges worldwide. And if you invest more here, there's still the big free stock promotion going on where you can get up to €524 in free stocks. And that's really incredible. The link to the broker and my review are also down in the video description. I also newly invested €1,500 with Mintos, and €1,000 of that went into a bond, as you can see here, from the Dolphin Group, one of the largest lenders on Mintos. The Dolphin Group issues consumer loans in Latvia under the brands Banknote and Vizia, and according to their annual report, they have been able to increase their profit over the years from 6 to €7.3 million. And as you can see here in the charts, this generally reflects a very good business development across pretty much all the figures. And here I have now invested at 9.5% interest per year, and this interest rate is also fixed. As you can see here, there is monthly interest paid, and in 2 years, the repayment will follow. As you can see here on the Mintos homepage, the largest share of my portfolio is now invested in bonds, because I simply find them better secured than loans, and the return here is really very similar and, above all, fixed. Here you can also see my other bonds that I already have in my portfolio. And if you also want to invest on Mintos, then click the link below in the video description, because with that you get an extra bonus that you don't get with the regular registration. By the way, I invested the remaining 500 euros of the 1,500 euros in loans, mainly those from iDefine in Spain. Here I mainly bought short-term loans. I've known ID Finance for a long time, and I also invest in their equity. There's also a bond with a 12% yield here, which I find quite interesting. I also invested 1,000 euros in Bondora Go Grow, which has now brought me to 7,434 euros, significantly more than in the summer. I'll talk more about this in the passive income section. Additionally, I bought 3,000 euros of Bitcoin at 97,000 euros, thinking I was being clever in a falling market. I bought it over the weekend, but then it just kept dropping further. Yeah, that's how it often goes, it's part of the game. And then I also put 2,000 euros into a secret investment, which I will reveal soon. On top of that, I invested another 250 euros into my Monefit savings plan, which I always do at the beginning of the month. So in total, that's 10,750 euros that I've newly invested. And now let's take a look at the charts. The iShares MSCI Emerging Markets shows very clearly in the 5-year chart how strongly emerging markets have performed recently, and the MSCI World is also back at a record high here. In contrast, the strategy stock currently seems to have no bottom at all and just keeps falling further and further. It recovered this year but then gave back all its gains again. I've already invested enough here, so I'm just going to let it run and keep an eye on things. If we look at the chart, we're now at a portfolio value of 478,000 euros, and at the beginning of the month we were still at 485,000 before I invested all this new money here. At the peak we were even above 490,000 euros, just shy of 500,000, but didn't quite make it. Over the longer period since 2022, we can see development more clearly. There have been fluctuations, but I keep saving consistently no matter what happens. And that's how it will continue. My Bitcoin position hasn't performed as well as I had hoped at the beginning of the year, but in return the ETFs performed all the better, as shown by the dark blue line here. We started here at 102,000 euros, and now we're at 146,000 euros. That's really remarkable. The P2P portfolio shown by the green line is just under 100,000 euros. The strategy stock has dropped and continues its downward trend. My interest earnings have now reached 15,000 euros since I started tracking this closely. This year's performance is at 5.7%. That's okay, but last year was of course significantly better. And if we take a closer look at this year, we can see that October was actually a slightly negative month here. But well, that's just part of it, like amen in church. But still, we started the year with 337,000 euros and are now at 478,000 euros. And that shows once again, yes, stock market performance is of course important in the long run, but you simply have to invest as much money as you possibly can. I also always push my savings rate and savings quota to the maximum. And with that, I just hope to become financially free early. We'll see whether it works out or not. If you want to follow me on this journey, leave me a like and subscribe so you won't miss any videos. And depending on how you calculate the return, we're now between 5 and 7% performance this year, and as a pie chart, my portfolio now looks like this. I still have crypto as the largest position in my portfolio at 40%, ETFs make up 30%, and P2P about 20%, which has become a bit too high for my liking. So soon I'll be investing more in ETFs and other investments again. I've now also included my cash reserve in Swiss francs here, and now let's just take a look at my passive income, I'd say. Here in October, we see 792 euros that I achieved. That's significantly less than in the previous month, which is because Debitum only pays out a lot of interest at the very end of the month, and I'm recording this a day before that payout. There should be about another 100-130 euros added, and Debitum is one of my favorite platforms, and I just really enjoy investing in business loans here. Very stable, very reliable, and now there's also a new overview page here, and my return is at 12.7%, which I find very good. As always, I've linked my experience report and the link to Debitum with an extra bonus below in the video description. With that, let's move on to Bondora, which paid me 33 euros and 95 cents at 6% interest. Here we have about double the amount of interest compared to July, since I have invested significantly more here. And you can also see that represented graphically here. In 2023, I withdrew a lot here, and currently I'm rebuilding this position. The extra bonus link and review are, as always, down in the video description, just like for every other platform here. With Devon, I'm seeing really strong results. Here, I'm getting almost 16% returns, and right now there's also 5% cash back. Really impressive. Devon is financing its own real estate projects here. I also visited them on site recently. They're also building very affordable apartments here, which I think is really great. And here I got a look behind the scenes. Definitely a strong investment that I want to expand further. I'm letting Guru run out here, and Fintown performed very well due to a higher repayment, which I immediately reinvested. Unfortunately, there was nothing from Indemo this month, and InSoil also ran as usual. With Lande, I now have more than €1,000 just sitting in the account, which I want to invest elsewhere now. I did this deliberately because I'm dissatisfied with the recovery process here, especially regarding how long it takes. And the interest rates are too low for me, while the default rate is a bit too high, with about 18 out of my 100 loans currently in default. Where should I invest the €1,000? Let me know in the comments below. I'm curious to see your suggestions. Lender market is running steadily and launch is a bit weaker, but I think that will improve. As I said, I'm also letting Maclaire run out, and on Mintos I earned just under €30 in interest. Here, some bonds only pay out every 3 months, so the cash flow isn't as regular as it was with the loans before, but that's okay. Monefit, on the other hand, pays daily interest. It's also my largest P2P loan investment, soon reaching €14,260. Soon there will also be €10,000 invested here in SmartSaver. This is being further increased through the savings plan, and €4,396 are invested in Walls. With that, I've now earned €1,403 in interest. Really cool. Here you see my account statement with the savings plan, paid out returns, and some distributions at the start of the month. Now I earn €1.95 daily. That's pretty cool. That almost pays for my coffee to go. The link to Monefit with an extra bonus, my review, and my on-site visit are, as always, in the video description below. After that, I also received interest from 2 secret investments, which I will reveal soon, and €68 from Swaper, although we currently have a problem here with the immense cash drag. The loan volume has dropped significantly, as you can see here, and if it stays that way, I will quickly reallocate a lot of money because I want my money to work for me and not just sit idle to such a large extent. I'm not exactly sure what the reason is, but maybe you know, let me know in the comments below. Twino has also performed very well, and Ventus Energy is once again delivering record interest. I've achieved more than 19% return on my account with €2,200 in returns so far. That's really incredible after just 1 year of investing, and right now there's 5% cash back again. That's really insane. If you want to secure the highest interest rates on the market plus get a solid cashback on top, then click the link below in the video description where you'll also find my updates and several on-site visits. Ventus is simply an amazing platform and I really enjoy investing here. By the way, I'm now earning €6.63 per day here, which I reinvest completely, but of course you can also have it paid out if you prefer. And lastly, Viainvest is really very stable, truly a great thing. It runs like clockwork, and honestly I should probably increase my investment here as well. So now I've earned €792 in October, and it will be even more after the payout from Debitum. And then, as you can see here in the chart, we've earned about as much as in the previous month. And if we look at the quarters since 2022, we can see that in the first month of the last quarter of the year, we earned almost as much as in the entire fourth quarter of 2023. And in the third quarter, we even doubled the previous year's result here. Here we can also see the annual view as a bar chart, a nice and steady development. And here we've also shown the development as a line chart where we've already reached €6,900 in interest this year. That's really cool. So this is what my portfolio currently looks like. I've shared this with you with full transparency. Maybe you have suggestions on what I should or shouldn't show. I'm satisfied with the portfolio and its development. There are weaknesses, like anyone, but maybe you'll learn something from this video. Now tell me, what's your opinion of my portfolio? Should I do something differently? Where should I invest the €1,000 from Lande? Let me know in the comments below. I'm looking forward to exchanging ideas with you. I wish you good returns. See you next time.